And so the way to do it, and I will always repeat my explanations, and I'm not going to apologize for that, because I feel that there's a lot of people who are tuning in and they don't know. And even if you've heard it before, it's always good to be reminded about how this works. Because when I first started learning, people used to talk about swing failures and no one really explained what it was. And it was really frustrating because for months people were talking about swing failure patterns. It's like, and no one really explained what it was. So a swing failure is this: you have a pivot, and a pivot will be like a wick in the low or the high. Yeah. So we have, let's just say this is our trade plan for the sake of example. And let's say you have a short trade plan as well here. So your idea is a swing failure of this wick here and this wick here, right? That's your idea. You're looking to short the top and long the bottom. You don't set limit orders because, for the reason that I said before, the reason why you don't set limit orders is because you don't know if the price is going to react or not. If the price comes into your level and just goes through it and you've set a limit order, either you'll be stopped out immediately, or if you haven't got a stop limit or a stop market, whatever, you're going to be crazy underwater immediately. And you don't want to be in that position. So you never preempt the price. You always wait for the reaction. You always wait for the reaction. You never preempt the price. You never say, just because there's like 5 million levels here and the confidence is like off the charts, higher time frame, this X, Y, and Z, that you're going to set limits. Because for the reasons that you don't know, the price can always ignore all of that and keep on going. And you don't want to be that person who was long and then the whole market was shorting and you pay them off for your stupidity. And I've done that. Everyone's done that. Everyone's made that mistake. That's how you learn. You make those mistakes and you realize that every single time that you do it, it doesn't work. And the times that you never do it, you think, damn, I should have just done it. And so you never get it right. So always wait for the reaction. Like I said, the reaction is this would be a reaction. I'll show you. So the price is going down, like it does. It goes underneath your level. This is your level. And it comes back up your level. And you want to see a little bit of volume there too. You can't ignore the volume. Okay. You don't want to see some kind of low volume. The more the volume as it crosses your level, the better. And as the price comes back above your level, as the price is moving back above your level, in that move, it's not going to take a long time. It's going to be quite quick. As the price is coming back, that's the failure. That's the swing failure. And then you mark it long. You have to mark it because the price is moving away from you. As the price is coming up, you won't get a position if you don't mark it long into that. Yeah, it'd be very difficult. It might be possible with smaller orders, but you still, by the time you get filled, it'll probably be cheaper to market long, because obviously market orders you have to pay the takers. The people who set limits are the ones who get paid. The ones who take market orders, they pay for the orders, so you're paying market fees. But it's probably going to be cheaper because you'll end up, the minute that you want to do it, you'll end up getting a better position. So for the time of the price flies away from you and you've managed to get a limit order, if it's even possible, depending on the speed of the way the price reverses, it's probably better to get a market order in that circumstance. And so you probably won't get the exact price that you're looking for, but probably somewhere higher. But that's a reaction. So you're looking for the reaction. Reaction is to go down and come back above the level, and you only look to take the market order as the price comes back above the level. Only as the price is coming back above your level. That's the idea. And then the invalidation is that low that you've just made, the actual low, and it could just be a single wick, because the expectation after you've gone into a swing failure and you've come back up is up. It's not down. You're not expecting this now. So if it does this and it takes the low again, then you're invalidated. Now, this is how you take a swing failure, right? For up or down, for the tops or the bottoms, it makes no difference. Just, there's only one thing to be aware of, okay? And you have to be aware of this, okay? Even if you take a swing failure, the market could also, so this is the problem. So the price comes up and you're in a position now, you're in a long, and then the price still reverses, it still goes down. And then what happens is it swing failures the swing failure, and it still goes up. And this can happen, and it can happen once, twice, and sometimes 3 times, and it's still correct. You're still correct. The idea is correct. Yeah. And sometimes it does it once, sometimes it does it twice, and sometimes it does it for the 3rd time. So when you're taking these kind of fast trades with a swing failure, you have to be aware of that. And usually what happens, with the first swing failure, the first time it swing failures a level, the people who you'll be in profit very quickly, usually what happens is those people will take their profit very quickly too. And what they will do is you take enough profit. So you have to calculate your profit. You take enough profit so that if the price does go down and stop you out, that you've still made money, that you're still won that trade. So you have to calculate how much profit that's going to be, and it may be 90%, you know, it may be whatever. You have to see, because it depends on how far the price will bounce. That's how you take your profit, because if the price goes up and you're in profit and you don't take profit and it swing failures you again, which it can, not only you stopped out at a loss, your trade idea was actually right, because it may do that. It may do this. So you have to bear that in mind. And the market loves to punish people who are early, and the market loves to punish people who are late. And so usually early longs get punished, and late longs get punished. And so that's why you're always taking profit, just in case you're one of those people. You just don't know. And sometimes this would just go up and you never needed to take profit, but you're just averting the risk. That's what you're doing. Now, if you take profit, you can still get back in, because you sometimes, or a lot of the time, what will happen is you can draw a Fibonacci retracement, and the price will come back into the golden pocket, the local golden pocket. And if you've taken profit, and then if you see a reaction, then you can put the profit back in. You can compound the profit, or you can just take a new trade, and then your validation will still be the same, taking the entry there, but you're still then only looking for a reaction. There are different ways of doing this, but that would be the best case scenario, where the price reacts and it gives you one chance to get in on a swing failure. And then there's also another chance to get in because usually it'll back test the neckline to continue going up. So there are like multiple chances of getting in on a reversal at a key level where there is a swing failure. So it's not like if I don't get this, I'm out, I can't get in. There'll be many chances to get in, but you just have to plan the attempts so that you know that you're getting in on a reaction at the right level of interest, but you're still technically trying to trade that swing failure idea, which will lead into a reversal. Exactly the same for longs and for shorts. There's no real difference, except usually shorts probably get punished more for some reason, but then they're more profitable, because if the price moves away in the downwards direction, then it moves much faster. So I mean, if you took a swing failure here, it's effectively the same idea. As the price goes up, you wait for the reaction. The reaction is for the price to go down. You take a market short, and that's your invalidation above that high that you've created. No, you wouldn't risk any more than that. You wouldn't go further. You wouldn't say, well, just in case, I'll go further. That's not how it works. That has to be your invalidation is the high that you've made, because the idea is that that's the high. This is it. If the price does come back, you're not expecting it to come back above that high. And again, the same thing applies. If the price does come up, it could stop you out and still do the same thing. So you still have to have the same mentality. You still have to take enough profit so that if you're punished, you still make profit because you've already taken most of your profit. And then if it does swing failure again, you can enter again and you can take profit again. And then if you see it comes into like the golden pocket, the local golden pocket somewhere, then you can enter again and you still have that top invalidation. And then you're entering with the compounded amount from the profits that you've taken, and it becomes a very profitable trade idea, assuming that it is going down. Now obviously if it's not going down, you have to gauge the strength of the price. And I think the way to gauge the strength, or the weakness rather, of the price is, in the first instance, it's going to be some sort of market structure change on the lowest levels, like on the 1 minute level, the 5 minute level. So also having an understanding of market structure will help determine whether you stay in a trade for a longer period or not. It's not that easy. If it was easy, we'd all be making money and then we'd all be rich. You see, after this shorted, you had a higher low, higher high. You only really confirmed the market structure change after all of this move down until it took this level here. As soon as it took that level, it made a lower high. People were looking to short because they saw the weakness in the structure. The structure had just made a lower low, and so therefore they were looking to short that. Give me one more second. Sorry.